CLO equity is an asset class that is getting more and more attention from large institutional investors today, including large public pension plans here in Texas. And I want to just talk about why that is, and also say a little bit about what CLOs are generally. A quick introduction on who we are. We are a small firm based in Connecticut. We have $2 billion under management and 25 employees. We are focused on CLO equity, so that's the equity tranche of collateralized loan obligations. I'll get into that. We're small, but we kind of punch above our weight. Since 2009, we've deployed close to $7 billion in CLO equity and CLO debt and warehouses. And at this point, we're probably one of the longest running and most active participants in the space. In terms of size of trading, I think we're the largest by an order of magnitude. We're told we're trading at about, we're at about $2 billion notional per year in trading, and we think that's over double what our next closest peer does. So we're pretty good at what we do, and we've been around for a long time. Why are we seeing more and more interest in this space? The basic reason is that CLO equity, CLOs offer attractive returns, the debt tranches, but CLO equity offers mid-teens returns, and there's just not a lot of things that offers those level of returns today. The University of Texas Investment Management Company, which I think at this point is the largest endowment in the country at over 65, 70 billion in assets under management, published a report in the middle of last year for their expected returns across the broad asset classes that they hold. These are the historical returns over the last 50 years from 1970 across treasuries, corporate bonds, stocks, and alternative assets such as hedge funds and private equity. They were healthy returns, and they easily beat the target returns of most pension plans, which is around, what, 7.5%. Today, though, UTIMCO expects these asset classes to produce much lower returns, in some cases half. So large cap equities, they're now expecting to produce less than 5% per year. Private equity, which has been a great driver of returns for most portfolios, is now expected to produce 8% per year. So there's just not a lot of things that offer mid-teens returns, and CLO equity still does. So just a quick comment on what CLOs are relative to CDOs. CLOs are often conflated with CDOs. CDOs are the stuff that blew up in the great financial crisis. CLOs are very different. CLOs hold mostly broadly syndicated loans of large U.S. corporate entities, whereas CDOs held really toxic stuff like mortgage-backed securities and asset-backed securities and things of that nature. CLOs are actively managed, whereas CDOs were generally static. But the biggest difference is that CLOs have had very little defaults over its entire history, since the early 1990s all the way through COVID. So whereas CDOs saw defaults of 30, 40, 50% across their debt tranches, CLOs had almost none. And you know, they're very robust, even through the most recent crises. It's a $1 trillion market today. So it's probably one of the largest markets that are still generally not broadly understood, although that's changing now. We're seeing investors move into more esoteric things like crypto and music royalties before they look at CLOs, and we think maybe we're just doing a poor job of telling the story, because CLOs are worth looking into, and especially the CLO equity tranches, which is what we're focused on. Today, there's over 1,500 US CLO transactions and over 130 different managers. Last year was a banner year for CLO issuance, with just under 190 billion issued. It's a little bit softer this year, but it's still healthy, and the forecast is for it to be healthy going forward. All right, so what exactly is a CLO? A CLO is a financial vehicle that buys corporate loans. The loans are from these types of borrowers, they're household names, United Airlines, Dell, GoDaddy, Uber. These are broadly syndicated loans from large banks. The typical CLO has around 500 million of these loans across 250 of them, and they're diversified across different industries. The financial terms are usually, there's a 2-year non-call period where the CLO can't be restructured, and there's a reinvestment period of around 5 years and a final legal maturity of 13 years. It doesn't usually go all the way to 13 years, and we can get into that a little bit more later. What are these broadly syndicated loans that these corporate borrowers are taking on? They're predominantly senior secured loans, so they're top of the capital stack, above high yield debt, above their other debt, and certainly above equity. They have first call on the company's assets, so in the event of a default, any kind of default, they have first call on everything the company owns. What that typically means is that in the event of a default, the recovery rates are pretty high, much higher than what you would get in unsecured loans. The loans are syndicated by large banks, again, household names, such as JP Morgan, Credit Suisse, Citibank. All right, so how are they funded, these CLOs? CLOs issue debt and equity and invite investors to participate in those. It goes from the top, investment grade, AAAs, all the way down to mezzanine and down to equity. And the investors are typically pension funds and big banks in the investment grade tranches, insurance companies. As you move lower into the stack, the riskier assets, you start to get asset managers and CLO managers themselves holding their own debt and equity, and certainly in the most risky tranches, you start to get hedge funds and private equity firms and specialists like us who focus on the equity tranches. All right, historically, why have CLOs been compelling against corporate bonds? Well, it's because they earned higher yields than similarly rated corporate bonds. The spread from the investment grade tranches starts at 70 basis points. This is an average, I think, over the last 5 years through 2021. No, excuse me, 10 years to 2021. All the way to over 300 basis points in the riskier tranches. So at any given level of risk, CLOs were offering higher returns while having very low defaults. So according to S&P, from 1996 to 2020, there were only 39 defaults and none in the investment grade tranches. That's a default rate of 0.29% across over 13,500 rated tranches. The default rate of corporate bonds is much higher than that. So CLOs have really proved themselves, and this is through the dot-com bubble, the GFC, COVID. They've proved to be very resilient. The CLO managers, there's over 130 of them, I think more now. Again, they're names that we all recognize: Blackstone, Napier Park, who was speaking here yesterday, Oaktree, Ares. Some of these are parts of larger institutions, and some are specialists, but they're all very credible investment managers, and they've been around for a long while. Their responsibilities are to trade the loans in the CLO to make sure that all of them meet the criteria for the CLO indenture, and that the CLO maintains the required coverage tests that the ratings agencies require to keep the ratings of the CLO. All right, so what exactly is a CLO trying to do? CLOs are trying to earn a spread between their loan assets and their cost of financing, so their debt. And CLO managers actively manage the CLO to try to maximize that spread. So just using some basic numbers that apply to over the last few years, these aren't the current levels, but let's say the asset portfolio of loans, 250 different loans, 500 million of them, earned 4% over LIBOR, over SOFR today, but over LIBOR. And the financing to buy those loans cost the CLO manager 1.6%. The CLO arbitrage is 2.4%. They're trying to maximize that. From that arbitrage, you would have to subtract the fees that CLO managers get paid, as well as other expenses such as trustee fees, and you get the net arbitrage. In this example, 1.9%. CLO equity, that riskiest tranche earns, is levered about 10 times. So before losses, before any defaults, and you have to expect those, CLO equity expects about 22.5% in this example. It's 10 times 1.9, that's 19%, plus the return of the unlevered portion minus expenses. It's 22.5%. But after you model in some expected losses, you get to the mid-teens, around 15%. Historically, according to Citibank, from 2011 through the summer of 2022, the average CLO equity tranche earned 17.6% before fees. So this is in the general neighborhood, and this is generally indicative of what we expect today. CLOs have been very resilient, and there's been very low defaults because of the way it's structured. Cash flows first go to the top of the capital stack, the investment grade investors, and whatever's left over goes down to the rest and all the way down to the bottom, which is equity. Losses, any defaults from the loan portfolios are first absorbed by the equity investors, by us. So we have the riskiest tranche, and that's why we're compensated the most. We underwrite our investments in equity to a mid-teens or low 20s return. But this is why there's been so few defaults. CLOs have to adhere to a lot of tests to maintain the amount of collateral they have relative to their liabilities, to maintain the amount of expected interest payments relative to the interest costs. Any kind of failure in those tests results in a diversion of cash flows, from equity, us, to the investment grade investors, but for that risk, we get compensated really well. Okay. We've talked about the expected return of CLOs, but why are they so compelling in the context of an institutional portfolio? One of the reasons is that they have front-loaded cash flows. So CLOs today are generally earning 20% cash-on-cash distributions per year, and we're getting those consistently throughout the year. So unlike some of the back-ended investments in alternative assets like private equity and venture capital or real estate, where you put in the money and then you sort of have to wait for a realization event that happens 7, 8, 10 years out into the future before you get the bulk of your capital back, CLO equity earns a lot of it early on. So CLO equity actually has a shorter duration than the investment grade tranches. And because of that, they serve as diversification against some of these other alternative investments. Additionally, getting those cash flows back early lets you take advantage of dislocations. So if something happens where loan prices fall, getting those cash flows early lets you reinvest at those lower prices, which is an attractive feature of the asset class. All right. We also think CLO equity is attractive because there's a lot of opportunities for alpha, active management. Trying to beat the S&P as a long-only equity manager is hard because the public equity markets are very efficient. CLO equity is not efficient. It's still very opaque and dominated by specialists and market makers. They're also structurally complex and non-standardized. So each one of these CLOs have idiosyncratic features, and the indenture documents that outline what those features are like 200 to 300 pages long, so you really have to dig into them. You have to understand what you're getting into. The transaction costs are very high. So trading in public equities, buying and selling costs fractions of a percent CLO equity can trade with a spread of 500 basis points or more. So casual participants in the space can get ripped off. You really need a specialist to do this for you, but the good news is those specialists can add a lot of value. There's also a wide dispersion in the performance of CLOs. So there, like I said, there's about 1,300 different CLOs. The spread between the best and the worst of those CLOs in terms of performance is very wide. I think I saw a Wharton study that showed the top decile minus the bottom decile on average has been 25% per year. So it would be very easy to pick the wrong horse. But the good news is that you also have a lot of opportunity to pick the right ones. And again, the ability to add value. And there's a lot of ways to add that value, either participating in CLO warehouses or, again, picking across the 1,300 different transactions. It's a lot more opportunity to do that than in the public equity markets. All right. Why now? Why CLO equity now exactly? Well, why CLO equity generally we think is compelling because on average you're earning mid-teens returns. But why now particularly? Because leveraged loan prices have taken a hit, along with everything else. From the beginning of the year to the end of June, the S&P LSTA leveraged loan index fell from 98.6 to 92.2. That's 6.4 points. To CLO equity, that's 10 times levered. So that's a big hit. The average, it doesn't go one for one exactly. It's not a decline of 60% in CLO equity values because of those very high cash flows. There's a certain floor. The average CLO equity tranche, I think, fell 15% through June year to date. We think that's really compelling because, again, CLOs have the opportunity to buy into those cheaper loans and earn a larger spread. Things have recovered since then. In August 11th, the loan index is back up to 95.4. And the loan index in general, it's a par market, so these loans tend to gravitate towards par at maturity. The loan index tends to hover around close to par. And most of the time, that's where it will sit. But there will be times like what we saw earlier this year when it takes a dip. We saw that in the GFC. We saw that in 2015 and 16. We saw that in COVID for sure. But it's these types of times that we get most excited because this is when we can add a lot of value. All right. This is just a quick analysis of what have been the returns to CLO equity when the leveraged loan index was at 92 or below, which was where it was at the end of June. This chart is a little complicated to read, but I'm going to summarize it in the next one. Basically, we are graphing on the vertical axis the average CLO equity tranche 12-month return, and the S&P LSTA leveraged loan index on the bottom axis. And then we just look at what have been the 12-month returns when the index was below 92 and what was it when it was above 92. When the index was below 92, the median 12-month return of CLO equity was just under 70%. The lowest 12-month return was 16.5%. When the loan index was below 92, excuse me, when the LSTA was, let me get this straight, hold on one second. When the index was below 92, the median 12-month return was just under 70%. The lowest was 44%. When it was above 92, the median 12-month return was 16.5%, and the lowest was minus 38.5%. So that makes sense, you know, the closer it is to par, the further it has to fall, and that's when you can see some losses. The greatest opportunities, though, come during dislocations like the one we are in today. And lastly, even though today is a great time to invest in CLO equity, we think timing is very hard, so we generally try not to time too much. investing in the average CLO equity tranche, this is according to Citigroup, produced $1 turned into 6.8. That's an average annual return of just over 17%. But if you try to time it, especially this locations like the one we are in today, if you miss just the first 2 months of those recoveries, you produce a materially worse return. So just like in any other asset class, timing is hard, and it's better to make a strategic decision to get an exposure to the asset class and leg into it, and especially in times like of dislocations. So that's it. I hope you found that useful, and thank you for your time.